A lot of financial YouTubers make me mad. They're bad for your health. Ugh, I'm trying to bite my tongue. I'm not trying to flame this guy, but my friend Marie just emailed me last night about this financial YouTuber who did a video on retirement planning, and I'm just sitting there in just astonishment at how bad this guy is. His advice is just, oh gosh. So we go way back in time. When I first started my YouTube channel, one of my first videos, I still wear my tie right here. Let's see here. I had 2018, in March 2018. I don't even know how many views I got on this thing. 168,000 views. And for a while, this was literally, if you typed in retirement planning, this would be the #1 video that showed up. It was like me, then John Oliver, that clown from HBO. Obviously, I've changed a lot since then, but that was in March of 2018. Now we're in September 2022. I'm still around. I'm looking older. Definitely not as sophisticated. Anyway, so check this out. We got right here. Right here. Atlanta Journal-Constitution makes a huge error. You've got to know your tax situation before you retire. The point being was there's a guy, a local guy, who's a radio show guy, kind of like Rick Edelman used to be in the old days, and I'm not going to say his guy's name. And he said basically every household, if they can make $83,000 a year in retirement, that will be happy. They'll all be happy. There's some study that says the more you make, it's like we call marginal utility in economics. There's a negative utility. The more money you make, the less beneficial that extra money is. But if you're on the other threshold, you don't make enough money. You need more money to generate your utility, your marginal utility, where you're saying, I am the happiest I am at this level of income. And they've done some studies, and they figured out it's $83,000 was the happiest, the amount of money you need to be the happiest. All right. And it's kind of silly, but his whole thing was he used a 25% tax bracket. And I said, I shuddered at that because so many people follows this guy. I'm like, dude, if you're married finally jointly in retirement, you're not you're not paying 25% taxes. And of course, the not understand the difference between tax bracket and actual your effective tax rate is another pet peeve of mine. And this guy that I'm going to talk about here in just a second did the same thing. It's kind of like not knowing the difference between actual kilowatt and kilowatt hours. Ask any electrician, an electrical engineer. If you don't know the difference between kilowatt hours and kilowatt, you're back in the rookie league. It's the same thing here. All right. So this guy says, we're going to assume you need $80,000 a year in today's dollars to retire. And then he takes a white piece of paper and he says, we're going to assume that of that $80,000 a year, you're going to get $30,000 from Social Security. All right. And this is just so freaking stupid. It actually ticks me off because there's not enough thinkers. There's not enough thinkers. In my business and other businesses, there's not enough thinkers. I posted a video or a thing on my community tab. I said, do electrons exist? And I showed this thing, I think is on Reddit or Quora or something like that, where this guy just destroyed this guy who said, yes, electrons exist. I can't prove it, but essentially if you stick your hand in an electrical socket, you'll know that electrons exist. And this other guy just destroyed that level of idiocy. Unfortunately, a guy who frequently comments on my YouTube channel said the same thing. He said, science and faith are incompatible. I said, really? They're both based on faith. He goes, that's not true. Electrons, for instance, you can stick your hand in a socket and you'll get electrified. I said, that doesn't prove electrons exist. It proves electricity. It doesn't prove electrons exist. It's based on faith. You cannot prove electrons exist. You think you can, but you can't. All right, so we can say they exist because electricity is generated. That's like saying gravity exists because things fall. That you can't prove that. Now you can make the assumption, but that's based on faith. The same thing here. Anyway, we just don't have enough thinkers. A lot of people just don't want to think. They say electricity, thus electrons exist. And I'm not saying they don't. I'm just saying it's not proven, man. It's not. Because an electron's a subatomic particle. You can't split an electron. Interesting. So it's subatomic, it can't be split. It's kind of like photons, man. I mean, come on. That doesn't mean they don't exist. But there is a faith into this, man. You can't prove it. Dark matter isn't proven. It is based on faith. It's okay to recognize you don't know, but it's not okay to turn around if you don't know and say what you don't know to be true, that you actually do know. You don't. Kind of like this. We have $80,000 is our expenditures what we need. You got a couple married filing jointly. They're getting $30,000 a year from Social Security, which that was my first thing. I said, really? Married filing jointly? They're only getting $2,500 a month? Okay. All right, so we need $50,000 from other sources. All right, so this is this guy's scenario. We need $50,000 from other sources. However, that's in today's numbers. So we're going to inflate this $50,000 at 3% a year to figure out how much we need in future numbers. So $50,000 is our present value, 3% inflation this guy's used, 10 years I think is what he says. It was what he says. So we're going to need $67,200 in future dollars to get the equivalent spending power of $50,000 today. $67,200. All right. I hope you all guys are following me. So $80,000 is what we want to live on right now. There's the equivalent of which $30,000 is coming from Social Security. So we need $50,000 from our portfolio. But $50,000 isn't coming from our portfolio because we have to inflate that. All right. So we're first and foremost, our Social Security is quite low. $50,000 isn't coming from our portfolio because we got to inflate that. We're going to inflate it at 3% a year. We need $67,000 a year from our portfolio in which to maintain our lifestyle that we want at $80,000 a year today. I'm like, okay, there's a couple of huge areas there. I've already pointed out one big one. So $67,200 is what this guy's saying. All right. So now $67,200, but then we got to add 20% tax. Frick is so stupid, man. Let me just do this real quick. $67,200 in 10 years is the equivalent of $50,000 today, all right, at a 3% inflation. We also got to pay 20% tax on that. He's saying a tax bracket, that'd be your effective tax rate, but we'll just give, I'm not going to flame this guy for that. All right, so we divide 67,200 by 0.8. Divide by 0.8 because that's a 20% tax rate, essentially, is what he's saying. That means we need $84,000 after tax, after inflation, a year from our portfolio. All right, again, we just simply take $67,000, $67,200. We divide that by 0.8. That gives us $84,000 is what we need. So net of taxes, net of inflation, in 10 years, what we thought was $50,000 a year is actually $84,000 a year. Oh, all right. Now, we're going to need that. How much do we have to have a portfolio at a 5% withdrawal rate to get us there? So, hold on a second. So, we need $84,000 a year from our portfolio in 10 years, net of taxes, or gross of taxes with inflation included in that. All right. How much do we need if we're going to take a 5% distribution rate? So, we divide that by 0.05. 84,000 divided by 0.05 gives us, oops, I just had it, 84,000 divided by 0.05, 1.68 million. All right, so we need to have 1.68 million in 10 years. 1.68 million in 10 years in which to generate $84,000 a year adjusted for inflation, gross of taxes, to live on $80,000 a year. But we need $84,000 from the portfolio because Social Security is still only paying $30,000 a year. Interesting. So I'm like, okay, first let's dive into Social Security. So we have a married couple filing jointly. Social Security is only $2,500 a month. That's absurd, but let's just run with it. So how come that hasn't been adjusted for inflation there? Guy. How come you haven't adjusted Social Security? Even if we use a Social Security cost of living of only 2.4, we're going to say $30,000 is our future value for Social Security. 10 years is what we're trying to see what the current value is. Remember, he's saying we need $80,000 a year in today's numbers. But he's saying of that $80,000, we're going to get $30,000 from Social Security. All right, either Social Security also should be adjusted for inflation, or we're using today's numbers and we're basically present value, a discount value of what Social Security is today. And if we're going to, one of these two things, you can't have it. You can't say in the future Social Security is going to pay $30,000, but today it pays $30,000 as well. That doesn't work. So we have to either back to get a net present value of Social Security for what it will equal to $30,000 in the future, or we have to inflate it. One of those two things. But you can't say Social Security is $30,000 in the future. If you do say that, then you have to present value what that is today. I hope that makes sense. It probably doesn't, because this used to confuse me all the time. It's okay. I'm just going to show you how freaking idiotic this stuff is, and it pisses me off. 30,000 is our future value. So we're going 30,000 future value. 10 is our N. The number year is 10. 2.4 is our interest rate, because that's what a cost of living adjustment I'm using for Social Security, which is based off the SSA, Social Security Administration. We're not making any payments. All right, so now we click compute present value. So 30,000 Social Security benefit 10 years from now, the present value of that is $23,000 a year. It's so freaking idiotic, man. 23,665. So 23,000 in Social Security benefits today is the equivalent of 30,000 in 10 years. That's less than $2,000 a month for a husband and a wife. But the average Social Security check is $1,700. It's so friggin' stupid. So if we're using $30,000 today, we want to inflate that in the future. So we say $30,000 is our present value. What's our future value? Compute future value is $38,000. Either way, it's freaking stupid just to say Social Security. And I need to do another video on this, because this is literally the biggest mistake people make. They look at their Social Security statement. They say, my Social Security benefit is only $2,100 a month. I'm doomed. That's in today's dollars, dude. Has not been adjusted for inflation. Never mind AWI, average wage index. It just hasn't been indexed. Yeah, so freaking stupid. All right, but anyway, let's go back. So let's take a gander, shall we, on this guy's portfolio. We need 1.68 million in 10 years. So he was using 750,000 as a present value at a 7. I don't care. At the end of the day, his conclusion was you need to add 14,000 a year to your portfolio at 7% a year if you have a present value of 750,000 to get that 1.68 million. The whole thing is just freaking shot to hell. I just destroyed it, but we're going to destroy it even more. All right, so let's jump into Right Capital. So according to this guy, we need $80,000 today's numbers, all right, which 50,000 comes from your portfolio, which means that's going to be 67,000 adjusted for inflation. All right, and he's throwing taxes out there, and I'm going to show you why it's stupid to use a 20% tax bracket, but be it as it may, 20% effective tax rate. And we have 30,000 coming from Social Security. So adjusted for inflation, we need $97,000 a year, of which 30,000 will come from Social Security, 67,000 will come from portfolio. $97,000 a year divided by 12 is going to be $8,083 a month. All right. So that's all inclusive. What about healthcare? It's included in this. What about inflation? Is it included in this? All right. Now we're going to go back to Right Capital. I'm going to show you that John and Paula Sample, we don't have 1.68 million. We only got 1.4 million, whatever. I just threw 20,000 shares of Wellington. It's in Paula's IRA, 1.4 million. All right. So now we're going to go to goals again. I'm just going to show you. We need $8,083 a month, which is $97,000 a year, which is essentially the equivalent of $80,000 today. But it's not, because we have Social. Either way, Social Security is going to give us $30,000 right here. I got John with no Social Security. Paul's going to get $2,500 a month at her PIA. That's $30,000 a year. So we need $67,000 a year from the portfolio. $67,000 a year, because we have $30,000 come from Social Security, and of that $67,000, some of it's going to be subject to taxation. This guy on YouTube said 20%. I'm going to show you how silly that was. Let's just go to retirement. Hope this makes sense. It just drives me crazy. All right, so I don't care about this. We're going to show you cash flows. We're going to show you. So we got $30,000 from Social Security. We need $97,000 a year, all right, which means we're going to have we got to come up with some money for taxes. We got to pay $10,000 of taxes. How much is coming from our portfolio? You want to take we're going to go over withdrawals from accounts. We're pulling 77,000 from the portfolio. We got 77,000 from the portfolio, of which 67,000 is going to pay the bills. That's what we need, but we still got to pay $10,000 in tax. All right, so if we look at the total tax, we're going to go to 2023. We're going to look at the 1040, 2023, our total tax bill. 30,000 from Social Security, of which 25,000 is subject to taxation. We got to pay 85% is subject to taxation. 77,000 coming from the portfolio. That means we got $102,000 of income total. We only got $8,400 of taxes. That's not a 20% tax rate. Effective tax rate. Our effective tax rate is about 8%. 8%. And that's assuming Social Security only gives us $2,500 for two people, husband and wife, who've got over $1 million in their portfolio. Yeah. So, as you can see, if we go back to retirement, we have income coming from where? Oh, Paula's Social Security. We got none from John, even though John is a spouse. Why would John not have any? Why would Paula only get $2,500 a month? Maybe she would, but John will probably get at least $1,250 spousal benefit. We got distributions from the 401k or the IRA of $77,000. Okay, that's got to come from someplace. It's going to come from her IRA, Paul's IRA. So $77,000 of $10,000 is a total tax bracket. We're not paying 20% in total taxes, man. It's not even close. It's 8%. It's less than 10%. On top of that, I'm only giving this guys, I think, 5% or something like that. Yeah, 5.2% rate of return. All right, I'm not even giving them 7%. And I only got 1.4 million. And even here, we got 55% probability of success. It's so freaking stupid, man. It just drives you up the wall. So here's, right here. Here, Paula dies, and John has no Social Security anymore. So Paul's dying at 86, 87, something like that. John's just living on, he doesn't have a spouse, a survivor benefit. That's just so stupid. So let me just do one quick trade. We're going to do income. And we're going to show that John has, we'll just say his own benefit is $1,000 a month. We'll take his at his full retirement age. And we'll say he's going to get $1,000 a month. Oops. Let's just do based on, there we go. And we'll just say he worked part-time. I don't know. Or maybe he was digging ditches as a 1099 employee, didn't save that much in Social Security. $1,000 a month will his benefit be? And watch the difference here between their ability to retire or not. An extra $1,000 a month is going to go a long way. Now they're sitting at 90% probability of success with leaving $486,000 downstream. With a lot less than, and that's retiring today, with a lot less than 1.6 million. If we go to cash flows, what's their, now they only need to pull 61,000 out of the portfolio because John's got an extra 12,000 Social Security. All right, but he's also going to get a spousal benefit. You'll see right here, 30,000 from old Paula. He'll get an extra $1,000 a month from his benefit. He'd actually get a little bit more than that. Right there, a spousal benefit. Yeah, 15,000 total. And then when Paula dies, he's going to get all of Paula's benefit as a survivor benefit. So not only am I only giving you 5.2%, not even coming anywhere near the 7% this guy was given. And we go to 1040. What's the taxes on this right here with the actual with actual John having some Social Security? 45,000 from Social Security, of which only 85,000 is subject to taxation. They need 61,000 from an IRA. They got 99,000 as their AGI. You take away your standard deductions. We got $70,000 is their taxable income. $8,000 again. They're an 8% effective tax rate. Oops. Let me go back to here. Yeah, right there. 8%. And now we're living in the state of let's put them in Georgia because I don't think the right capital does. Let's see, where did I got these guys living? California. Yeah, let's put them in Georgia because in Georgia is even better because once you're over 65, they're not going to pay any taxes to the state, to Governor Kemp or our shadow governor Stacey Abrams until you make a certain amount of money. This is the widower's tax trap right there. So we want to avoid that. But you can see their effective tax rate is 10%. No state tax in Georgia. There's no 20%, no 25% on less than $100,000. Ain't happening. And as such, this whole thing is preposterous, man. It drives me up the wall. Now, I guess you can make an argument. I don't think you should, but I guess you could make an argument that, hey, man, they got to pull, in this case, cash flows. They got to pull $60,000 from their portfolio. They're paying $7,900 on, we'll just say $8,000. So this is their net flows, how much they have to pull from the portfolio, and this is how much it costs to pull that. So 8,000 divided by, what's that, 60. Even here it's only 13% tax rate. I mean, I don't, we go down here, they're paying $11,000 on $118,000 in income. That's not a 10%. I mean, that's just not even a 10% tax bracket, effective tax rate. It's just not. I mean, I guess if you want to look at their tax brackets, we can do that, and they're going to be actually right here. Yeah, I mean, they're well below that's the right one. We want to go here. Yeah, they're right there. They're at the 12%, right at the 12% effective tax bracket. They're underneath the 12% tax bracket right here. Then they jump up above the 12%, but they're not anywhere near the 22 to 25% tax bracket. That's a tax bracket. Remember, tax bracket and effective tax rate are two completely different things. Just because they're in a 20%, a 22% tax, no, they're still in the 12 to 15%. They're above the 12 to 15% tax bracket, but they're below the 22%. Again, all that matters ultimately is your effective tax. This is your effective tax rate. Look, clean as the wind-driven snow right there. Anyway, So many people are going to comment on this video, and they're going to say, "Oh my goodness, I need 1.6 million to get $80,000 a year." And it's just not true. It's just not true, man. This guy had them using 750,000, so it's like, well, as their current value. I'm like, and putting 14,000 a year in at 7%. I'm like, dude, I don't have 750,000, and I'm 52 years old. So you tell me I'm doomed? No, I'm not. Why are we doing this to people? This is where I do agree with Dave Ramsey, man. He's like, we gotta get people saving. We gotta get people paying off debt. And if we can kick him in the pants and get him to do that, that's a wonderful thing. I just think his assumptions on future returns are way over optimistic. But be that as it may. This case right here is the exact opposite thing. You can't do this because you don't have 750,000, and you're just trying to live on $80,000. It doesn't make sense. Yeah. All right. Love your thoughts. I'll put this other video as a link, and I'll pin the other video I did. Right. I think it's right here. Yeah, right here. When you can still see me in my monk. Now, I didn't even have my jacket on. Ugh, what an ugly dude right there. I'll pin that, and you can watch that too. Right. Love your thoughts. We'll see ya.